Hi Nitin sir, am I audible to you?
Yeah, I can hear you very well. Yeah.
Great, you are well audible as well.
Okay, thank you.
So let's wait for a couple of minutes so that more people
Sure,
can
sure,
join
sure.
and benefit from the session.
No issues, no issues.
And for our attendees, like please feel free to share the link within your circle so that you can benefit from experience of Nitin sir. So, guys, few things before we start the session. The session is purely educational, so any view shared by our guest will be personal. And if we name any company, so that won't be any you may consider that as a biased view. So, we would request please take today's session as a starting point, so as to learn the nuances. Anything which we say during the session should not be construed at for or against any company. And yeah, so once again, like we had one wonderful session with Nitin Mangal sir, and today also like it is going to be an interesting one. So Nitin Mangal sir is a SEBI registered research analyst. He has got over 15 plus years of experience in Indian and global equities, and he's a pioneer in corporate governance and accounting research in Indian market, who has successfully developed a product which we discussed in our last session, which goes by the name of Analysis Beyond Consensus. So currently, he's working as a co-founder, India Independent Insight, predominantly catering to institutional investors. And the link to our last session is pinned to this spaces. So those who are yet to like listen to that wonderful conversation can surely revisit after this session. So Nitin sir, welcome once again, and let's have some opening
Thanks.
note around today's topic.
Yeah, thanks, Prince. So yeah, definitely, it will be a wonder. I guess I'll be sharing knowledge regarding the subsidiary analysis and the promoter group entities dealing, because this is a gray area, and I've seen that a lot of people in the investment world struggle around these things. So I thought this can be a good opportunity for me to share what I learned over the time. And definitely, I'll not be sharing the name of company, so without naming the company, but these will be case studies which you may find in any company which you are investing or you are evaluating for investment.
Great. So for attendees, like as and when you feel like if you have any questions around whatever we are discussing, please feel free to send in a speaker request, or you can simply type in your question in the comments. So to start with, Nitin sir, how to check investment in subsidiaries for impairment test?
See, normally, so I'll just start from the beginning. So like we have seen, many companies do have subsidiaries, and a lot of companies also make a complex structure, whereby they have way above subsidiaries of 50 or 100. So it becomes very important for the investor to know what is actually happening in those subsidiaries at the at their balance sheet and the function statement. So in the annual report of the company, you may find that brief table whereby they give what is the net worth of the company, what is the turnover, what is the profitability, and all those things. But all these numbers are at the standalone level, and they do include any dealing which has happened within the group. So it may be possible, that sometimes these numbers may not depict you right picture, but thereby, so uh, there are few thumb rules or there are few indicators which is available in the annual report. If you read that, then it should immediately hint you that there may be chances of impairment. So one of the biggest indicator is the deferred tax assets. So in when we go into the deferred tax schedule, in that you may find this is a very common note in many companies that we have not created deferred tax assets for the carry forward losses, and the amount of the DTA would be this, etc. Now, why this is important? Because if company has not created any deferred tax assets, it means that there is no virtual certainty that these losses will be recovered in near future. So it may lead to some impairment in the investment what the company has made into the subsidies, including the goodwill what they are carrying the books of account. That is the first indicator. Second thing, nowadays companies have become very smart. In fact, I'll just, in global scene also, I've seen many companies whereby, the company shares the valuation techniques while evaluating the impairment test on the goodwill. Now, we normally don't look at, what kind of assumptions have been drawn on while evaluating the impairment test on the goodwill. But this becomes very important, and if you see a trend over the years, then you may find out that may be playing up with the discount rates. They may take some aggressive terminal growth rate, etc., etc. So that these goodwill may not qualify for the impairment. In financial statement, whereby you will definitely find out that whether these companies are into trouble or not.
Right, sir. So, Nitin sir, a small request. Can you please check voice connection on your end? Like it is little low on voice from your side. So, if you can check that, that would be great. So, moving on to next question. So, what does it mean when loan to subsidiaries gets converted into equity?
So, most of the time we don't care if any loan has been given to subsidy. And even I personally, if it's 100% own subsidy, it's just transferring fund from one pocket to another pocket. It may not have a major implication. But if subsidies loan has been converted into equity, it clearly depicts that subsidy doesn't have a sufficient cash flow to meet its liabilities, and that is why these loans have been converted into equities. And this has been done to safeguard the impairment test on the investment and the goodwill appear in the financial statements. So this is a very critical point, which you may not find in very large cap companies, but especially into the small cap and micro cap. This has been used in technique, technique whereby they can avoid the impairment of the investment, and they can just do a window dressing whereby they can just show you a better picture in the financial statement.
Right, sir. So, how important do you think goodwill assumptions for the subsidiaries?
Yeah, because see, this becomes very important, because based on the assumption, a management estimate, an auditor certifies that whether this goodwill has should be impaired or not. So if let's take an example, so if I increase the discount rate, then what will be the implication on the overall, you know, uh, NPV or DCF of the company? So you just play around with the numbers, you increase the discount rate or decrease the discount rate, or you can increase the terminal growth rate. I'll just give you example. A company in North America, they used to have all these investments, and if you see, they used to have zero terminal growth rate, and suddenly in 1 year, the terminal rate appears in the books of account as 6%. So this was done only to protect impairment of the goodwill regarding the subsidiary, and to show to the investor, that everything is fine at the subsidiary level, our investments are safe, and all those things. But when this company collapsed after 3-4 years, then everybody realized that this was the biggest indicator. If if we had paid attention to this particular indicator, we would have known it 3 years back, rather than in the current scenario whereby the stock price has already been crashed.
Right. So, how to get a sense on internal control at subsidiary level, because that's very important.
Yeah. So, Prince, so what happens, when we read the financial, the audit report, especially the consolidated audit report. So, whereby there's a certification of internal control given by the auditor of the company. And many a times they do take a leeway whereby, they say that our report on internal control is only related to the parent company or the standalone entity, and we are not commenting anything regarding the subsidiaries of the company. So this becomes very important because all this information may not be available anywhere else in the annual report. So you have to see the financial statement of the subsidiary, whereby the audit report of these subsidiaries, which is readily available on the website of the company, that what is the qualification, what is the certification of auditor has been given. Because many times there may be a case of the theft or embezzlement, or there may be, that there is no inter audit is being done, or there is no there is variability regarding the fixed assets or inventory. So these things you will find out only in the internal control report, which states that whether it exists to the size of the company or not, and if there is a weakness in that, it may indicate that there may be some problem in the overall group structure.
Nitin, so if the parent company and the subsidiary account are audited by different group, so that could be a normal norm, or like it signifies something.
Uh it can be done by the different auditor. It's not that all the subsidiaries should be audited by the single auditor. But if there's a material subsidiary, then it should be audited by the same auditor, ideally, because then you have some faith that the same auditor is being auditing at least the material portion of the consolidated financials.
Right. So, other than the ICDs, what are the other ways to give benefit to the promoter group companies?
Yeah, so Prince, so see, this is how you say that how the management and the promoter has evolved over the way of time. So when I started my career in 2006-7, I used to see that a lot of companies used to give loan and ICDs to the promoter group companies, just to get them benefited at the low rate of interest on those things. And by the time 2010 or 11 came in, that everyone was aware of that, whenever they see an ICDs or loan to the promoter group entities, they used to raise a red flag, or used to stay away from the stock, those previous stocks. So promoter has also become a smart. So, now most of the promoter doesn't follow the route of ICDs and loans. So rather than that, what they do is that they enter into a normal sale purchase transaction with the company, with the promoter company. And as an investor or as an analyst, we say, okay, these transactions are all normal in nature, and these have happened at the arm length price. So there is no issue in that. But nobody check the financial statement of these promoter companies, because in few of the companies I have seen that these promoter companies uh, turnover only arise because of dealing with the listed arm, or it may be 90% of the total turnover of the promoter company. Now these companies are making PAT margin of as high as 40%. On the contrary, that listed arm is making only the PAT margin of 8 or 9%. So this is another way, whereby the promoter can get benefited or get enriched themselves by entering transaction which may look legitimate to you, but which is not the true case. So uh, always, if there is a transaction with I'm not saying all the transactions are fraud, but if there's a transaction which is sizable to the financial statement of the company happen with the promoter group company, then you at least go and check the financial statement of all these promoter group companies, so that you can see whether they are making any abnormally high margin, or is there any other ambiguity in the financial statement. So there's another case whereby I can tell you, that uh, one company was using the promoter arm for window dressing or what do you say, evergreening of its financial statement. So though that margin was inversely proportional to the performance of the listed arm. So whenever listed companies' financials, excluding the dealing with the promoter companies, goes down, uh, the promoter company charge less margin to the company so that the listed arm can get benefited. And it and when when listed arm is making good margins, so they used to give higher commission to the promoter company. So somehow it is evergreening. They were smoothing their financial statement, and they are playing around with the numbers.
Right. So we have one speaker, Venkatesh. So Venkatesh, you can unmute and ask your question. Okay, he got dropped. Anyway, I'll check him later. Although you touched upon this, but are there other ways to interpret sale and purchase transaction with the promoter group companies, or you covered all the nuances?
I guess this is the best way to cover into that. And again, so sometimes it happens that these promoter companies. Just I'll give you example of. Let's take an example, of a real estate company, right, or in construction company, whereby the contract has been awarded or subcontracted to XYZ company. Let's the best of the companies available in India or globally. Now, what happens is that these companies, so the contract doesn't allotted to them directly. So what happens that they do first give this contract to the promoter company, and promoter company transfer these agreement or these subcontracted the mainstream construction companies. So in between, whatever margins promoter companies makes, it's a cost to the shareholder and cost to the company. So if project could have been completed for 100 crore rupees, but here the company is paying 120 crore rupees. So the cost of project goes up, and promoter get benefited by 20 crore rupees of additional amount what they charge as a brokerage or commission in between. But in entire dealing, there is no role of them. It's just a routing of a transaction through one more layer of the promoter company.
Right. So, does promoter group company health can have impact on its listed arm? Obviously, I feel the answer to this would be yes, but are there any like exceptions also?
There may be some exceptions, but see, why promoter wealth is very important, because if other investment whereby the promoter is bleeding, then and he needs money to safeguard his own investment, and from where he'll get the money. So then there may be some burden on the listed arm. He may put, via some intercompany transactions, deposits, loans, or maybe some sale purchase transaction. So this give you an indication, if promoter is in dire need of money, then those repercussions may come on the listed arm. So otherwise, there may not be any bad intent, but to safeguard his own interest, he may get into this kind of transaction. I feel.
Right. So there is one question that is company specific. We'll avoid, but again, we take the necessary portion of the question. So revenue recognition mechanism. So how we can like look for it in any companies and what all things need to be like checked properly.
So revenue recognition has now come under 100, I guess, in days 115, right? Which has changed a lot. Now it is clearly state that the performance obligation is complete. So earlier, what used to happen is that there was a transfer of property. So once transfer of property is complete, then you can recognize the revenue. But now, new accounting standard says that performance obligation should be met. So now the gray area in few of the companies is that what they do is that this new standard will allow you to unbundle the contract and unbundle the revenue. Now, how does this unbundling happen? So and how they play it with it. So in that, what they say is that if you're unbundling, so let's take an example. Buying a product of the company, and along with that, there's a services, all those things. So all for that particular for the entire services and the product, the company is charging me X amount. You know. Now, accounting standard says me that I cannot book revenue on the entire services plus product which I'm selling. I need to unbundle it between sale of product and provision of services which I'm providing to the customer. Now, what it says that the revenue should be booked at the estimated standalone price or standard standalone price. So, if you go, so just two products which comes at 100 rupees each. So ideally, the cost of these two products will be 200 plus 100, 200 rupees. But if you are buying a bundle thing, so it may be available to at 180 rupees. So ideally, revenue should be recognized at 180 rupees, despite the fact that you are unbundling it. But few companies become smart, and what they do is that they unbundle it and they apply an estimated standalone price to each and every unbundled services and plus product, and they are able to recognize the revenue of 200 instead of 180 rupees. So this is an innovative way whereby they can create the revenue recognition, which you may not be get sense just in initial years, but if you see the growth in unbilled revenue over the years, the unbilled revenue surpass the growth in unbilled revenue surpass the growth in revenue of the company, which is a clear indication that there may be some aggressive accounting policy followed by the company. And I guess for you can always look for the over the years rather than looking at the 1 year accounting policy. You can see over the years that whether the accounting policy is consistent over the years or it has changed in between, which will give a fair sense that whether it has followed the proper accounting policy or not.
Right. So, Nitin, like too many subsidiaries is a clear red flag, or there is also like ways to look at it?
Ideally, yeah, too many subsidies are clear red flag. So if structure is too complex, then so a lot of management bandwidth goes away in managing these subsidies, rather than managing the operation of the company. So too many subsidies are always red flag for me. There may be few cases whereby it has not been a governance issue, but largely 90% of the cases I've seen, 99% of the cases I've seen, that this is a red flag.
Right. So, Harish, sir, you can like unmute and ask your question, or maybe if you have small input on whatever we are discussing.
Yeah, thank you, Prince. Thank you, Mr. Mangal. I had a very simple question and some observation also. Being a insolvency professional, we are having opportunity to go slightly deeper into things than the usual. Am I audible, Prince? I'm not sure.
Yeah, sir.
Okay.
Yeah,
Yeah,
go
Harish.
ahead, please.
So one thing on a high point, basically, not talking about what I exactly gone into, because Nitin knows more than me, and that is what he's sharing with the entire audience. But one question which I have now, so what kind of, though obviously there is some disclosure obligations on the listed company on the related party transactions, and those transactions in a very routinely manner being also disclosed in the audited balance sheets. But do you think, with your experience, is these disclosures are sufficient enough for a layman investor to look at and make a sense out of it, whether this is in the interest of the in the entity, or as you rightly said that it is just for the sake of flourishing the promoters which are sitting outside, and their interest while investor, the listed company, are not at any benefit, I must say, but surely for the on their own cost. Is it disclosure sufficient enough, or you suggest some more changes? Because as you rightly said that more to be seen. Like, for example, one example, you say that we need to see the promoter's balance sheets, promoter group company balance sheets. Please appreciate most of the time those balance sheets are not readily available. Private limited company, and
Yeah, yeah.
proprietorship also. I see very large listed company. I noticed that the promoter have the proprietorship company, and it is a sizable sale and purchase from the listed company. So very difficult to get to those numbers. But whatever being disclosable or otherwise disclosed, is it sufficient enough, or need to be sir more disclosure required to be done?
Harish, I appreciate your question, and this always comes in my mind. But if I see globally, the way the related party transaction has been disclosed in India, it is far superior than anybody, disclosure available anywhere in the world. I would say that the disclosure required by the Companies Act in India or by the SEBI is much superior. See, you can ask for details or disclosure related to the listed arm, the subsidies. But as a regulator, I can't say, that show me the balance sheet of the promoter company. So there can be a legal issue in that. So that is why the regulator is not asking for that. And you can't keep each and every company into the same bucket. You can't start your analysis with the hypothesis that this company is a fraud or all the companies in India is fraud. You can't start with that. So there may be, most of the companies I've seen, so there are a lot of companies which are good in India. There are few bad companies which follow such kind of bad practices. And otherwise, it become very hassle, to give all the information about the promoter companies. But I guess disclosure, as far as disclosure is concerned, these are sufficient in nature. And as you said, the information what you quoted that there is an proprietorship form of the promoter, and the related party dealing is quite huge. So we can't access the financial of the promoter group definitely because it's a proprietorship form, so it is not available to anyone. But if the quantum of related party is more than 20% of the sales, 10% of the sales, then itself it raises the eyebrow, and you can definitely ask the management over the conference call, or you can approach the management through IR or someone else, through a proper channel. I guess they will be able to share the details with you. Otherwise, you can definitely, it creates a doubt in your mind, definitely. But I guess disclosure is sufficient in that sense. I don't think the disclosure is not sufficient. I hope I answered your question right.
Yeah, of course, yes. But yeah, of course, more to be desired, because disclosures are at least to the layman person. For Nitin, yes, I think you are the master of the trade, so you can make a sense out of it. But then for a layman investor, a company, group company, and then sale quantum this much, say purchase quantum this much, or be another 6 companies lying in the same bracket. Each one is contributing to 10% equivalent. All in all, it goes up to 50-60%. But yeah, of course, it doesn't attract the interest or the attention of the layman investor, and then we don't know what exactly going into. I had some, but one observation I have, Nitin, one about it. In the listed,
Sure.
unlisted space, I had experience on both the sides. And as an insolvency professional, let me tell you, it is not that very small set of companies are indulging this kind of activity. I had slightly different view about it. Majority, I must say, with my little experience, whatever I have, majority which I witness are having this kind of small practices, which are gone unnoticed because shareholders are not questioned. They don't have the tools to question promoters at the right time and get away with that. I mean, that is what exactly my observation about it. Yeah, I appreciate on a large 7,000, 5,000, 6,000 listed company, you say 300 would be having that kind of thing. Okay, from that perspective, maybe a smaller number to see. But then if you see overall, quantum wise, or the significance of vis-a-vis the balance sheet size may not be that great, but nobody's in majority are not indulging in this. That is something which I had a different view about that. Majority indulge it.
No, I agree. I agree with you, Harish, to an extent. Even 300 is a large number. So But again, I would see for my understanding or the way I have been groomed in the market, it's totally different. So see, being the chartered accountant or being something else, I can raise question on any, if you give me the best of the company in India or globally, I'll find something which may be a red flag in the company. So that can happen in any company, but again, if you see it from the angle, that whether this transaction was happened, whether to betray or at the cost of the minority shareholder interest or not, that is more important. The intent of the management is more
Yeah.
important,
Yeah.
because we understand that if you are doing business in India, then there is cost of doing business in India. तो प्रमोटर पैसा कहाँ से लाएगा तो so in fact मैं भी एक कंपनी रन कर रहा हूँ so I may be the honest guy, everything, I'm not doing anything wrong, but I need to bear some cost while doing all these regulatory filings and other things. So how this money will be paid off. So there may be some cost to do business in India, and all the transactions should be looked into the way, not as a suspicious, but I feel that what is the intent of the management. So I always say that one of the best corporate governance company in India, I've seen once in a bad phase, they were window dressing their financial statement. And when I saw the financial, then I raised this question. And then when I was analyzing it, I realized that this window dressing was not done to to run the stock price or to give a better picture of the market. It was done deliberately only to safeguard the company so that the debt covenant would not breach. So this was in the interest of the shareholder. This was not against the interest of the shareholder.
Appreciate. But one.
So the intent is very important, I guess.
Please go ahead, sir.
Yeah, so that's why I say intent is very important.
Yeah, one thing coming out of this entire discussion so far, Prince and Ritin, you agree with me that the high time in India, equity culture is increasing. Individual people, household families are putting their money into equity, despite the fact they don't have direct control on this businesses. High time there should be, investor activism to take care of that situation on an institutional basis instead of individual basis. Very difficult because you have a lot of limitation on individual basis. Yeah, but institutional basis, yes, I think that is one thing which is not so far part of any serious thought process among institutional level, whether it's a mutual fund, whether it is HNI or whatever. But yeah, high time that this area also need to be seriously looked upon so that you can protect, at least question them. I mean, that question itself is put the defaulter, investor, promoter on the guard and think twice before he goes into that kind of thing, which is unexplainable otherwise. So let's see. I think hopefully someday people will realize it and start working on that side. Prince, this is the platform which you can also take a note of this one activity that need to be seriously looked into, because if investor is active, half of time his interest would be watched in a normal manner without whatever the disclosure being done on behalf of the SEBI guidelines or other disclosures, ROC compliances and everything. But yeah, yes, let's waiting for day. Then people will start questioning promoters on the AGMs and investor calls and all that. So far, it is not there. I'm sorry for that.
Right. Thank you, sir. So Nitin sir, like any sense on what the information on the company's executive compensation structure and policies in light of forensics? I mean, how we should look at these pointers?
Yeah, so Prince, so I always see, that, okay, normally what we see is that how much promoter is drawing or how much the management team is drawing, but nobody goes into nitty-gritty of that. So, there may be X number of examples which prima facie may not look material or it looks like kya hai, but, somehow it will tell you what is the culture of organization, how the internal control in the organization, and how the promoter or these KMPs will get benefited or at the cost of minority shareholder. So I always see so there's a disclosure required in the annual report. Where company has to give that what is the median salary of the promoter and median salary of the employee, what is the increase in that over the in the last compared to the last year and all those things. Uh, so if like in many cases I've seen that the promoter salaries or KMP salaries rise faster than or higher much higher than the salary of the normal employee of the company. It can raise a red flag, and then if you see how the profitability has been derived, there may be some exceptional income and all those things, because all the commissions given to the directors are linked to the PAT, the net income of the company. So somehow the companies try to create fictitious profit in the books of account so that they can get enriched at the cost of the shareholder. That is one part. The second part is that of late I've seen the small companies, whereby they say that there is no formal offer letter has been given to the promoter of the company, and they are drawing X number of salary and all those things. So it will tell you the culture and the internal control of the company. That if you can't give an offer letter or proper formal engagement letter for the director of the company, then you can sense about the HR policy of the company. So and how would be the internal control, and how would be the uh, work culture in that organization. So for a smaller company, it may sound okay, but if some company has to grow about 100 crore of 200 crore rupees of revenue, then they need to have a strong HR policy in place. So if you can't, and which is start from the top-down approach, so if you can't give a formal engagement letter to the promoter of the company, then you can't expect it to be given to the employees of the company.
Right. So, Kaushik, like, just in case you have any question, please feel free to come in. So Nitin, like, how does I mean, how can we ensure the independence of external auditors and the effectiveness of the audit process within a company? What we can, I mean, what should we look for?
Auditor or even director? I don't know, like,
Yeah,
versus
yeah.
auditor.
External auditors and like how we can find out the effectiveness of the audit process.
Audit, again, it's a subjective call, so independence wise, so one company is analyzing, so, the address of the auditor and the address of the subsidiaries of the company were the same. So if all the things are operating at the same level, you can always sense on that whether these auditors have been independent or not. Whether they are doing the uh, the proper diligence or not. Again, the audit fees is also important component to realize, to see, overall scheme of things, if there is a sudden rise in the audit fees and if become material portion to the profitability of the company, then it can be a situation whereby the auditor quality has been compromised and all those things.
Right. So one question is from Aditya. Can you how DTA can be manipulated? What can be inferred from DTA?
So DTA is nothing, so like how the DTA and DTN has been analyzed, I guess that's a small concept. So DT, if there's a deferred tax liability, it means that this is not a tax liability right now, but because of the certain difference between the Companies Act and the Income Tax Act, like depreciation, so in the Companies Act, you charge depreciation at the lower rate, however, as for the income tax rate, depreciation is charged at much accelerated rate. So there's a timing difference of that. And because because of that, the liability has been created in the books of account. So as per the company that you may be charging a lower rate, lower rate of higher tax rate. However, under the income tax, you are paying lesser tax rate. So these liability may arise in future. This is a DTA DTL concept. And same way, if you have paid an excess tax rate as or you have made an excess provision of a tax as uh, and there'll be a future benefit which will maybe arising to you. So this is how the DTA has been created. The deferred tax assets have been created. So ideally, the cases of the DTA is that if something is disallowed under the Income Tax Act, however, it is allowed under the Companies Act. So this is how the DTA has been created. Or if there is an unabsorbed depreciation or uh, past losses, which has not been uh, set off as on date. Uh, this then other than that, I guess yeah, these are the two three examples where normal examples whereby the DTA is created. So the manipulation happens in that the company may use the creation of DTA because if you create an DTA, it will reduce your tax rate, effective tax rate in the P&L statement of the company. So sometimes, I've seen not in Indian companies, but in global companies that, they use this DTA for smoothing of the profitable income statement, So in the bad years, they'll recognize DTA in the books of account so that the tax rate goes down and your profitability boosted up and your EPS boosted up.
So, I mean, Nitin, what all mechanisms are in place for shareholders to voice their concerns and exercise their rights, just in case, like, if they want to?
I guess for raising the concern, they can always talk to the IR of the company. They can try to reach the management, or they can raise question on the conference call or AGMs. This is, and I guess if somebody wants to go to litigation, I guess the minority shareholder, there's a provision in the Companies Act, which applies on the minority shareholders for the protection of minority shareholder, I guess. But I guess for that, you need to have more than 10% of the stake cumulatively, not the single shareholder.
Right. So, Nitin, like any case studies around whatever which we have discussed so far? Any other case study to your mind?
Yeah, so see, there may be a lot of things which may not be visible in the financial statement, so which may not come under the purview of the promoter group company transaction, which prima facie will not look like a promoter group company, right? So I was analyzing one company, and uh, this company was doing a acquisition, continuous acquisition. Every year they were doing acquisitions and all those things. And somehow, when I was looking at these companies, so I find out that all these companies were having a Mr. X, who was director in all those companies, and he have resigned just before this acquisition. Uh, so the resignation of this guy was happened so that the company should not company has avoided this acquisition as a related acquisition done via related party transaction. But if you look at the history of this guy, if you try to see his social media profile and all those things, because if he has sold off three, five, six companies to the listed arm, he's a serial entrepreneur, and must be a good guy and having a good social media profile. But there's no trace of this guy on any social media platform. You'll not find anything about this guy. And somehow, if you go and so, which may not be possible for all the investors, or may not be for the retail investor, but when we go and do our channel checks or promoter checks, we were able to find it out that, this guy was a very good friend of the promoter, childhood friend of them, and he used all these entity to cipher out the funds so that, these companies can be sold at much higher valuation than the actual valuation of the company. So that promoter can, take money out of the company for their personal enrichment. So this was one of the wonderful study, which I was doing it, and which was uh, which was not coming under the radar directly if you're looking at the financial statement. So you have to go much beyond that to see the traces of that.
So, Nitin, like, so as to we have creative accountants across the industry. So as to like save ourselves, it would be wise to look for the financials of the companies for a considerable period of time, say 5-7 years, or like even if we check it for few years, we can be able to find out these nuances in the financials.
Normally, when I look at the financials, I always look at for last 10 years, because 1 year or 2 year financial statement may not depict the true picture. So a longer run uh, overview of the financial will give a better picture and will tell you the nuances have which is lying in the valuation of the company, and will help you out to figure out what are the ways, what are the areas whereby you have to dig more, investigate more. So it's always should be the long run, not the short run.
Right, sir. So Kaushik, any questions? Kaushik, you're still on mute. And like for our attendees also, just in case any questions on your end, please type in the comments, or you can simply send in a speaker request. I think some troubles on his side. So Harish sir, do you have any questions to I saw one of your comment.
Yeah, so I'm not sure, but yeah, of course, if Nitin is comfortable, I just want to understand, a lot of oozing out of this G group. Any view you want to talk as per your comfort?
Not company specific, sir, but
Okay.
yeah,
Okay.
the general thing I can definitely talk
Okay.
about.
Okay.
Yeah.
Okay. Yeah. Right. Because ultimately, a lot of things are coming out of which is mostly related to non-disclosure. So something the subject matter of us, and for very that reason, I was prompted to talk about it. But yeah, I can appreciate your position. Thank you.
Yeah. Thank you.
Thanks.
Thank you very
Thanks.
much.
Yeah, Kaushik, you can go ahead, please.
Thanks, Prince, and sorry, phone got switched off. Hi, sir. I hope you're doing great. Sir, my question is
Hi.
based on insurance company. Basically, how to value an insurance company, because there is an embedded value which comes on their balance sheet. And how do we value? Because the normally they are writing off something which is for an 10 years and 20 years and very longer period. So how can they manipulate the numbers, and how like basically how to look at them?
Kaushik, to be honest, I have not valued any insurance company, so I'm unable to comment on that. So I have not covered any insurance as such in my life. So and especially valuation is not my stronghold. So I'm I'm not the right person to comment on that, I guess. But yeah, we have Deepak as well as a listener list, Puneet Bhai as well as listener list. So I guess if they want to comment on this, yeah.
I would love to hear from Deepak sir also, sir. If possible, can you send the request?
Yes, yes. Puneet, I have sent the request and also checking with the. So meanwhile, one question on corporate social responsibility to particular family NGO. So how it should be viewed?
Uh, in few of the cases, I've seen that these NGOs are being run by the promoter relatives, uh, and if you go on see on the ground, that there is no social work is being done by these NGOs. So this is all just to enrich the promoters themselves. But these are very rare things, and I guess for that you have to see that what is the quantum of the amount has been given to this trust through CSR. That is also important thing. Because quantum is misclined, then it's unnecessary effort to investigate into that. But if quantum is higher, then it's always raises eyebrow, and it can be good case to investigate. But in a couple of cases, I've seen that uh, these NGOs were being owned by the uh, relatives of the promoter, and this was just to enrich themselves rather than doing any social work.
Right. So one question is around how intangibles one should read. For IT companies, generally it will be high, but for other like manufacturing, if it's more than 50%, then should we view it as a, I mean, should we be skeptical about it?
I guess time has changed, because now with the new Ind AS norms, you have to value a lot of things which we not used to value those things. So it's fair that lot many times a lot of new kind of intangible which we never have in my life in our life, like customer relationships or all these things, they come or appear in the books of account. So yeah, if something is above 50%, then definitely raises a doubt. It's a fair chance to investigate, that how these intangibles are arise and whether these companies do have that much the worth or not. So, but yeah, so for that you have to see the revenue potential of the company. So, in few other cases, I was looking at these companies. These companies were acquired at the absurd valuation, and huge amount of intangible was created. And the companies were having a decent turnover. But when I saw it, the most of the turnover was being derived while dealing with the listed arm. And because these companies were not related parties, they were being disclosed earlier. But as soon as they become related party, it wasn't disclosed. So if all the revenue is coming back to the listed arm only, then question can be raised that why this much amount, the excess amount for which the intangible is being paid. So you can definitely ask for the management.
So Nitin, at times, like we feel like too much analysis leads to paralysis. So do you ever face such kind of thing, over analyzing company, or like maybe not at this point in time, but maybe in some time past when you used to just started off, or maybe in middle of your career?
It happens, so if you create a doubt, so see, that's why I say, you have to see, all these things into the, in the realistic way, whether these things are okay or, with the given the size of the company, whether these things are, tolerable or not, or acceptable or not, So definitely, if you just, so as I said, if I want to question the best of the best governed company in India or globally, I can definitely raise some question on that. So because we all rely on the publicly available information, and there can be sometimes interpretation issue whereby you can interpret something which is not the intent of the management. So management intent may be good, but the financial statement which you interpret may depict you something else. So, but I feel, what do you mean? How you draw this line of the too much analysis is a paralysis. If you don't do a deep dive into the company, then you don't know anything about that company, and if you are just investing, being a blind man. So then I won't say it's investing. It's a gamble which you are playing in. So you have to do a deep dive into the financials of the company, business of the company, the sectoral uh, aspect of the company. So you have to do deep dive, and how you dive. So how anyone draw the line, and whether it is you are getting too much into that, or it is sufficient enough for you. So it's very difficult one to say.
Right. So, Kaushik, any other question on your part?
Yes, so I have another question. Sir, I just wanted to understand on the manufacturing part, there is a company that I was looking in from Mysore. These people were like, they're currently going for the listing. So these guys, currently when I see with their current financials, they show that they have an cash flow from operations to be on negative, and this is basically because of their receivables part being on the suppressed part side. When they are trying to come onto an IPO side, if this has been suppressed very lot, and this is being greater than that 6 months part, if we see the disclosures and all how the receivables are looking. So how do we kindly look into this kind of companies? But the payment payer is actually the government for them. Should we consider this payment will not be written off, or like should we try to reduce that from our financial statements on the P&L side and make our own financial statement and then go ahead about it? Or like what will be your approach?
See, here the receivable, the counterpart is very important. So as you said, if receivable is to be from the government, so that government receivable is always elongated. So you see the most of the companies, especially into the construction space, they always have a elongated working capital cycle just because they are dealing with the government agencies. And you may find many companies, multi MNCs, who are dealing with the government, who are having the government contract. So they do have receivable whereby the aging is more than 2 years. So I feel, but most of the receivable from the government is secured in that way. So they don't default, but and so the risk of the write-off is very low in that sense, until unless there is a dispute on that front or not. So I guess if it is government receivable, it's okay. It's nothing alarming in that sense, I feel.
Right.
Sure, sir. But Prince, can I go for another question?
Please, please.
Yeah. Sir, if it is the government, but recent policies, if we see that the government only tells that we have to do the payment for GST claiming and all, it's something around 3 months. And when it comes to a private player, it is 45 days. So this rule lying, and that is how a lot of other companies' working capital has been going down. And if we see, they are like becoming more easy on the working capital. But will not be applicable for this kind of company who is like an EMS player for morely concentrating on the defense side. Will not be applicable for them.
It
Isn't it
will be
fair?
applicable for them, but as you said, that even the government is claiming that that the period will be reduced and period has been reduced. But I was looking at few of the MNC players. So whereby the receivable cycle is very elongated. So, they are waiting for the payments since last 1.5 year, 2 years. And especially in defense, the process is totally different. So it's not very easy process, whereby you get the payment once you deliver the goods, you'll get payments in 45 days or 90 days. It never happens in that way. And also you need to understand, so in many, while in initial phase of my corporate life, so if you are dealing with this government, so there's always a retention money which government always retain with them, so that, and that period may be 6 months to 2 years, so that they can protect themselves if the quality of goods what you supply to them or the quality of work you have done for them is not up to the mark, then they can write off, they can retain that amount with themselves. This can have so that retention money can be 10%, can be 20% in some cases. So practically, see, saying something on the number is, or news item is totally different, but practically how the things are shaping up. So if you look at many companies, especially on the industrial automation or who are into the industrial construction, you see that their working capital cycle, especially when it comes to the government contract, is always elongated. It's never shortened. There may be some improvement, but it's not a huge improvement which has happened. It may be wrong, but this is as far as my understanding, or given the fact that whatever companies I looked at, I find out that nothing much has happened. So it may have reduced by, let's say, 30-40 days, or but there's not a drastic fall from 2 years to 6 months. I haven't seen that.
Thanks. That was a good answer for myself. Another question is on PLI. Now we are seeing like a lot of PLI incentives are started flowing onto their cost and reduction on their cost of 5 to 6%. So a lot of companies, again on the EMS sector side, they are passing on this cost to the branded players by giving them discounts or like 60% of PLI is being passed on. Uh, can we hear any entry gimmicks can happen over here, or anything can be like very glorious things can be showed and that can be like added again here?
Uh, it can happen. So I've seen in one of the company, whereby they, in the income statement, they have recognized this incentive from the PLI scheme. And after 1 year, they write it off. So there can be some gimmick which may happen. So, sometimes the promoters are notorious, so they can do it, whatever they want. But ideally, it should not happen because if it is a promoter, it's related to the government entities. So, normally, we don't see a lot of gimmicks happen around that.
Got it, sir. Thanks.
Any other question, Kaushik? Okay. So Puneet sir and Deepak sir, I have sent you the request just in case if you wish to join and want to say 2 cents around the topic, and that would be great for our audience. And Nitin sir, like the questions which I had in my mind, and a few of our speakers also asked. So more or less all the questions are covered from my end. But just in case like you had something more around the topic and yet to discuss, I would appreciate like if you.
Uh, there are few cases which I'm just, I've seen first time in my life. And these are very abrupt cases, especially related to the independence of the board of directors. So in couple of companies I've seen that either son of the promoter of the company or any relative of the promoter of the company, he has been designated as independent director in the company, so which itself raises a question on the independence of the board of directors of the company, and can depict what kind of the culture the organization is having and why they are doing all those things. Also, in one of the cases, I have seen that the executive director of the company, which used to be a guy a person who used to be an executive director. Later on, he has been made independent director of the company. So, if a person who is aware of entire dealing of the company and being the executive director, how can you make this guy as an independent director? He'll not be an independent person. So this lot many times this independence has been compromised when it comes to the director of independent director of the company, and it may be done with the bad intention. I don't know, like again, but it's a gray area, to investigate and to ask to the management. You can definitely caution the company on that front. Also, so in few of the companies, you see that the commissions have been given. Commission as a percentage of sales has been given to the independent director. He's an independent actor. You give sitting fees and XYZ fees to him. But being independent actor will not be, you will not pay any commission for the sales to this guy. So somehow it compromises the independence of these people into the board of directors, I guess.
Right. Puneet sir had joined, but I guess some glitch on Twitter's and he got dropped. Let's see if he wish to join again. I see him as a listener. Let me send in a speaker request. And one last call for our attendees, just in case. Yeah. Hi, Puneet sir.
Hi Prince, how are you?
All good, sir. Hope same for you. So, Puneet sir, like forensic is also very close to your the investment framework. So, would appreciate like you have been listening to Nitin all along. So, any 2 cents on the topic or maybe anything you wish to add to it?
Yeah, honestly, I don't know what I can add to what Nitin would have already spoken. I'm sorry, I was, breaking a lot in between. Plus, I had another call, so didn't listen to everything Nitin said. But I'm really, I would be really doubtful that there is anything which Nitin would not have covered. So, but yeah, the topic which you have for today is obviously one of the more difficult ones to make judgment calls on because of slightly lack of disclosures when it comes to subsidiary based information. Uh, Even though promoter group company part is still a bit more available in terms of information, but subsidiary informations are usually more difficult to source. So it's a very relevant area in the forensic world, especially if you are looking for any high allocation idea. So definitely a space which requires a lot of discussion. But if there are any specific questions around it, maybe I can answer. But I'm pretty sure Nitin would have covered most of it. So yeah, I really don't have much to add here, except for the fact that it's very important. Maybe I can add just one point. When I joined, somebody was asking a question about as a retail or as a novice investor, how do you make judgment call? I would simply add one point to that, if you really have to put so much effort into finding the details of a subsidiary, you might as well avoid that company, because generally, uh, there's no dearth of investment ideas. I've always said that forensics should ideally, if you have to do a lot of forensic work for a particular company, maybe that company doesn't deserve a place to be in the portfolio at the first place. So from the simplicity is the easiest and the best answer when you're approaching forensics, rather than trying to become the best at this art. You might as well want to find ideas elsewhere. I'm just saying more from a retail investor's perspective. But anything specific, I can probably answer.
Yeah, sure, sir. So Kaushik and Harish ji, just in case you have any question to Puneet ji.
Yes, Prince. Sir, as I asked earlier for the insurance company, and that too basically on the life insurance company, how do we look at them?
How do you look at them in what sense? I mean, are you saying from
Because
the
yes, I'm actually speaking about their asset side, because it's a contract which is lasting for more than like 30 years and 40 years, and there are a lot of assumptions to be made on their embedded values. So that is the reason I'm asking about it.
Yeah, it's a difficult area, I'll be honest. I mean, see, the PVIF and NB calculations both have a dramatic amount of assumptions which goes into it. All the assumptions are given. So one thing which you obviously can do is go and check across competition what kind of assumptions are being used, avoid the aggressive ones, and especially if, I mean, to make a judgment call on those assumptions, trust me, it's just not worth the effort even to attempt it. I'm sorry if I might sound like, I don't understand, but half of the things we'll not be able to understand as outside investors in insurance companies. Insurance companies, like banks, are largely a black box when it comes to the important and key assumptions. So yeah, I mean, there is no easy answer to the question you have asked, to be honest.
Sure, Rajan, thanks for that. By any chance, did you get any chance to look at LIC? And it's like swinging around here and there. A lot of things which is coming into them. So, any thought on
Not
that?
really. As I told you, right? I mean, insurance is largely a black box for me. Majority of such businesses I tend to avoid, where I can't make a decent judgment call. So, not really. I mean, I've never been invested in that business, anyways.
Got it. Thanks, sir. Thanks. Fair answer.
Yeah, these are low ROE, high uncertainty businesses. I'm not very interested most of the time in these kind of, unless and until valuations are screamingly cheap, which we haven't seen from the time these companies have listed. So maybe this will come to radar sometimes when the valuation becomes slightly more reasonable to warrant a look. But as of now, no. Again, my personal judgment. I'm sure all the disclosures have been, or all the disclaimers have been made. But I am a SEBI-registered investment advisor, so don't construe this as an investment advice at all, please.
Right, sir. Yeah. So Nitin sir, anything closing remark on your end? Because we are almost done with all the questions, or anything you want to interact with Puneet sir?
No, I guess I agree with the point, that too much, so see, forensic, I feel, the forensic I always say in last conversation also I said this, for me, the forensic is a common sense, so I come from a background, whereby, my schooling happened in science, biology, and from biology I came to the commerce, and became CA. So initial understanding of the account was very low for me. And for understanding the account, I used to, do a lot of common sense, techniques to understand a lot of things. And even though I'm using a lot of common sense while analyzing the company and doing the checks. So something which is being told by the company, if as a common sense doesn't make sense to me, then it makes a fit case for me to investigate more into that. So I feel as an investor we should apply the common sense. So I'll just give you example of how the management reacts to many questions, or harsh question which is being asked by the analyst, or some fund manager. So if you ask any technical question, then management says, that it's an in-depth thing, it is governed by the accounting thing and something like that. They always try to avoid the question, and rather than not giving the proper answer, they just give this excuse of accounting and all those things. But these things doesn't suit, because being the analyst or PM, you understand the basics of the accounting standards. So at least they may not be thorough in the accounting standard, but they do understand the accounts. So these are the nuisances which is being done by many management. These are the legitimate way of avoiding the questions, or just to complicate the things unnecessarily. So I guess as far as policy is concerned, you can definitely do a lot of common sense investing. Now you can think that whether these things make sense if you are doing a business, or this situation comes to you or not. So that's the best way of dealing with the forensic, I think. So, because being the retail investor, you may not have that bandwidth to invest to do that much of the analysis of the companies. So there'll be restrictions on times, there'll be restrictions on resources. You can always, or you can use some rules which are the legitimate way of.
Right, sir, rightly said. And
Prince, I'll give you one perspective. Okay, look at all the large multi-baggers which you would have seen in the last decade or so. Uh, Hardly there you will find names which required you to do a lot of deep drill on the forensic side of things. Either things are very clean and doesn't require too much of investigation, and if it requires too much of investigation, generally, I mean, again, it's you will find exceptions, of course, but generally, it's a good idea to move on from an investment vantage point. As I said, unless and until you are a family office, you want to put a large chunk of capital to a particular idea, or it's a high allocation stock. In those cases, it warrants those in-depth investigation. But otherwise, majority of them are, as Nitin rightly said, it's very commonsensical to an extent that you can, while you're working, you will probably get an answer. Yeah, okay, this block looks very clean, and there isn't much. So, so yeah, I mean, better to approach this with simplicity rather than complexity.
great note to end today's session. And it's always wise to use common sense and aware of things. And investing is one thing which you can do till you live. So obviously you can graduate over a period of time learning the nuances of forensics, which is very important aspect of investing.